Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 6th of October 2016 and we're briefly looking at the argument in favour of UK investors buying gold and silver. Regular listeners are aware of our general scepticism towards gold and silver pumpers. In fact, when we began our channel and produced our first video on the 16th of March 2015, we were totally convinced that gold and silver prices were not going to move up anytime soon. And certainly not to the $5,000 to $10,000 an ounce level the pumpers were pushing for gold and the $100 to $400 level they were forecasting for silver. In fact, we were right, and we rapidly saw gold decline to as low as $1,049 and silver to $13.58. Now, today, compared to the price as of the 16th of March 2015, gold is up 9% and silver is up 8%, having recovered from those lows as a result of the Fed not raising rates more than once, despite its promise to do so, and the shock that the UK's Brexit vote has had around the world. In sterling terms, for quite a while, we were also correct. On the 16th of March 2015, gold stood at £780 and then fell to £694, and silver stood at £10.54 and fell to £9.06. But what has happened since then? Well, today, with gold standing at £993, it is up some 27%. And silver now standing at £13.91, it is up 32%. So what happened? The answer, very simply, the fear of Brexit, then Brexit, and now the fear of the aftermath of Brexit. How can we support that conclusion? Well, we've all seen the news as to what has happened to sterling. Even the Financial Times couldn't resist the headline, quote, "Sterling near 31-year low against dollar as May sets Brexit start date," unquote, published just 3 days ago. It then went on to point out, quote, "Against the dollar, sterling was down 1.2% at $1.28. within touching distance of the July the 6th drop to $1.2796, when the pound hit its lowest level since 1985. The pound was 0.9% weaker against the euro, with as much as 87.37 pence needed to buy a unit of the single currency, a level not touched since 2013. Finally, it quoted Charles St. Arnaud, Nomura's foreign exchange strategist, who said, quote, "The decline in sterling is another reminder that the market doesn't like the uncertainty that Brexit is bringing, that the negotiations will be hard, and that the probability of a hard Brexit has increased." It was clear from the Prime Minister's speech at the Conservative Party conference this week that a hard Brexit deal was going to occur. This means the UK standing fast on its total control of immigration, which flouts one of the key pillars of the single European market, which is freedom of movement of goods, capital and labour. If Theresa May insists on this, then Britain has to look elsewhere for its markets, especially if the EU remains intransigent. The negative impact of leaving this arrangement will be considerable, as the UK is seen as a gateway to Europe, both geographically and politically. Many important businesses have headquarters in the United Kingdom to allow access to the single market. By seeking to leave the single market, Mrs. May has triggered further worries for the future of the UK, and this is being reflected in the price of the pound. This worries traders and foreign exchange dealers too. Data from the Commodity Futures Trading Commission showed that hedge funds nearly doubled their net short positions on the UK currency to $5 billion in the week to September the 27th from the previous week, as bearish sentiment towards sterling re-emerged. That ended 4 straight weeks of net buying of the pound. UniCredit today announced that it sees the risk of the UK coming out of both the EU and common market as not sufficiently priced in by markets, and so therefore likely to lead to further weakness for sterling. Societe Generale see even more potential upside for the euro versus the pound and the yen from a pure yield comparison point of view, since both these currencies are unlikely to see higher yields. It sees the pound to dollar exchange rate going sub $1.25. Even the bookmaker Betway has slashed sterling odds of falling below $1.20 to the pound, and is giving odds of a 5-to-1 chance of the pound-dollar exchange rate falling into the 1-to-1 or 1.09 region again. So what does this mean for UK gold buyers? Well, to us it's obvious. If sterling is likely to fall by another 10% against the dollar, then it makes sense to buy gold. Now, we're already of the opinion that gold has entered into buy territory in US dollar terms. And even if we're wrong about gold prices, but right about sterling, gold would have to fall another 10% in price, which would take it into around the $1,140 territory for investors not to be better off. Now, of course, we could be wrong on both accounts. But even the IMF has slashed the UK's growth rate by 50% for 2017, and if they're right, and they have more resources to calculate than we do, then how can sterling strengthen, especially short term, with this level of uncertainty overhanging it for the next 2 years, while we negotiate our way out of the EU? Yes, there is more risk buying gold and silver in sterling, bearing in mind its huge rise already encountered. However, if there is to be more sterling pain on the horizon, one has to look for currency protection. And to us, the solution is obvious. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Our Facebook page, which is updated daily, can be found at facebook.com/illuminatisilver. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.